Another explosive start to the trading week, only this time it's not AI from China, it's the tariffs that were not coming, then not coming again. And the markets get tossed around once again, but on net, we end up lower on the 2 weeks of opening volatility. And of course, the next question from here is what comes next? Because it is now that we have to figure out where this story is going to proceed. And the question with the tariffs apparently now off the table, at least in part, once again falls to figuring out the macro. And the macro, once again, is busy this week with all kinds of event risk setting up to guide what might be the market bias from here. So what we'll do is we'll take a look at what the markets did last week, because there is, in fact, some insight there. Compare that with what's going on this week with this violent start out of the gate, and then take a look at the key macro waypoints that are going to shape next steps. Here is last week's performance. Needless to say, a leg lower for stock markets. S&P ultimately down 1.1%, NASDAQ down 1.5%. And needless to say, the DeepSeek shock at the start of last week was the main culprit. We spent much of the week then trading sideways. The initial weakness, of course, significantly mitigated once the dust settled. The news there initially seemingly getting people to think that somehow China has leapfrogged the U.S. in the AI arms race. Those sorts of expectations were very quickly put to bed, but nevertheless, the markets took a look at the offering that DeepSeek put out there and considered, well, if before we thought that we had baseline expectations for how the AI build-out would proceed, now we have to come to grips with the fact that those expectations may be off, and it'll be some time before we know what the new path forward is going to look like. And so with that uncertainty in hand, the markets ultimately still finished the week in the red. The more interesting bit here is that yields are likewise lower. So whereas before we had this very clear dynamic where the markets were looking at economic data and saying, if the Fed is less likely to delay rate cuts, that's good. If they're more likely to delay rate cuts, that's bad. So when we got that US CPI data and it was a little bit better, a little bit cooler, at least at the core, and suggested the Fed would be on track to cut as much as the markets think is the baseline, that's currently hovering at about 2 cuts this year, in line with the Fed's own forecasting, then we are in better shape on risk sentiment. And so there was this interesting inverse relationship between what was getting baked in on yields as an extension of Fed policy expectations and what was going on in stocks. Last week was a notable departure from that dynamic. Consider that before the week had a rise of 1.7% in the S&P, 1.5% in the NASDAQ, and yields were coming in, but only very modestly. And so you had a situation where at least the direction of travel was in the same direction as we've seen it in recent weeks, but already you were starting to see something of a break in this dynamic. We look what ultimately happened in the aftermath of DeepSeek's performance. Of course, that preceding week was CPI week, and the DeepSeek week ends up giving us yields down and stocks down, implying a level of risk aversion that then brought an appetite for bonds, not as some sort of a play on a less dovish Fed, but rather as a de-risking sort of vehicle, and stocks, despite the lower yields, could not make hay of it. Crude oil likewise down, gold higher, sort of speaking to the same part of the narrative as what we see in yields. The situation for the euro and the dollar a bit mixed. The euro ultimately a touch lower last week, but the dollar far from uniformly higher. In fact, in the case of the yen, it manages to rise 0.4% last week, again, seemingly rhyming with this pullback in yields and reiterating this idea that we are perhaps looking at a bottoming in the bond market as you run out of speculative juice on the Fed story, and especially as risk appetite stops responding. Then there is the performance we see today. Of course, we had all kinds of fireworks leading into the weekend on Friday. First, we got news that the planned tariffs on Canada and Mexico for the start of February would be delayed until the beginning of March. Then the White House came out and put those rumors to bed, saying, no, we are going to get the tariffs. Then we got the tariffs over the weekend, 25% on Canada, 25% on Mexico, and a 10% increase in tariffs on China. And then over the course of today, first, the tariffs on Mexico got delayed after a call between Mexican President Sheinbaum and Donald Trump, and a subsequent conversation between President Trump and Prime Minister Justin Trudeau in Canada put those tariffs on ice. So we had news of tariffs. Then those tariffs were delayed on Friday. Then they were undelayed. Then they happened over the weekend, and then they got undone before they had a chance to even be implemented. And so we've had a lot of back and forth here. In sum, once sort of the dust settles here on the price action, we find that we have a negative response from stocks, ultimately. It is not nearly as bad as it was when the tariffs were initially announced near the trading open, and losses were at their most extended. We were looking at very significant declines for the S&P and the Nasdaq. We end up closing down 0.7% for the S&P and 0.9% for Nasdaq, so lower but not nearly as bad. And the bond market ends up telling an interesting story. Long end yields stay relatively steady, but the front end goes up, as if suggesting that maybe if the tariffs were to be implemented, or as we get an increasingly active push and pull on this subject, there is more of a reflationary risk near term, and maybe that gets the Fed to sit on their hands for a little bit longer episodically. But that downwind, you don't get a similar boost in yields, because ultimately if there are tariffs, they're going to be negative for growth, and that negativity will keep rates anchored and rate hikes contained as we look further afield. So interesting sort of price action there. Gold up around the uncertainty, euro down, but the yen, again, interestingly higher, as if reflecting more the bond market than the buoyant U.S. dollar that got stronger almost across the board as a consequence of these announcements. Certainly much stronger against the euro, the pound, the Australian dollar, the New Zealand dollar, the Swiss franc. Dramatically so against the Canadian dollar at one point, while the conversation around maybe still tariffs on Canada was still ongoing. So lots and lots and lots of volatility. And the upshot, ultimately, not much of a build in yields, higher gold, higher yen, and weaker risk sentiment, as though we were looking at something very much akin to classic risk aversion. Stocks down, long end bonds up, long end yields down, and everything that follows in adjacent markets. Now, what do we look at from here? Well, if ostensibly the tariff conversation has been put on ice for a month and we're not going to get much more, there's of course the matter of the Chinese tariffs, but they follow other tariffs that were already there. So perhaps that's a longer term story that doesn't get any more immediate headlines for now. But with at least the immediately explosive bit of this story, the Canada-Mexico piece, for now in the rear view, we look to economic data. And the next key release here is the ISM service sector report, the expectation that we're going to come into 54.2 on that index, up just a touch from 54.1 in the prior reading. We already got numbers from the manufacturing side of the story today, not that anybody noticed with all these tariff headlines. And there was a bit of a positive surprise. As ever, these ISM numbers work as any PMI indexes do. They're diffusion indexes. So 50 is the center line. Above 50 is growth. Below 50 is contraction. The further you go above 50, the faster the growth. The further you go below 50, the faster the contraction. And so what you find here is we were looking for another contractionary reading on manufacturing. 49.8 was expected. We ended up with 50.9. So an unexpected expansion in the manufacturing sector in January is what all of this essentially boils down to showing us. In fact, we consider this outside of the sort of flat reading almost that we got in March. This is the fastest growth for the sector here since August of 2022. Now, we came somewhat close to adjacent levels in September 2022. And if we look back to March of last year at a 50.3, we were not contracting. But besides that, between March and the end of last year, we were looking at 9 consecutive months of contraction in manufacturing, and that was not what we saw in January. Moreover, the backing for these numbers relatively strong. So we can see here new orders surging higher, employment surging higher and actually expanding for the first time since the beginning of last year. If we look at this green index here, you can see it is now north of 50. That is, job creation in manufacturing is positive now for the first time since back here. This is May. And then the pricing component, much, much sharper. We can see that the line here measuring price growth for the manufacturing sector, the highest since back here. So we're looking at essentially the fastest inflation since May. So the makings of this upside surprise right here, seemingly a generally positive sort of mood in the sector. And of course, if this extends to what we end up seeing for the services side, as indeed we might, because if we take a look here at the way U.S. economic data has been performing relative to expectations, it's holding near what would be broadly in line. That would be the zero line, but it is biased positively. And so we have a bit of a tendency toward higher than expected outcomes implied in this Citigroup data that tracks how outcomes perform relative to expectations. And so if we end up seeing something here that is akin to the manufacturing side from the services bit, especially after we saw blisteringly high inflation in the ISM numbers for December in the services survey, then, of course, we extrapolate that into the Fed conversation and just how yields will move from here. Jumping around to the end of the week, bookending us on U.S. event risk will be the U.S. jobs report. Here, the expectation is for a rise of 170,000 jobs, with the unemployment rate holding unchanged at 4.1%. And again, here, this is the upshot. The risk seems to be toward data that is slightly better than expected. And of course, the knock-on from there is to these aggregates. As we look here, the market is pricing in 41 basis points in rate cuts this year. So that's a little bit shy of the Fed's 50 basis points, but close to it. For next year, the market is very light relative to the Fed, only 21 basis points baked in, whereas the Fed wants another 50, according to their forecasts from December. That's boiling down to 62 basis points in all, compared to 100 basis points that the Fed projected. So the question now becomes, if you get hotter data, do you start, at least for this year, to edge back toward this territory up here where the market was looking for maybe only one cut this year, and then you start to flirt with the possibility that indeed, as long as the Fed remains in an easing bias, that's as low as one can go without a full Fed head change. As long as that full head change isn't on the menu, that officials certainly don't seem to think that it is, then we are near a bottom in the bond market, and indeed, perhaps have already seen it. And so this then is where things get interesting. If the data starts getting hotter, but the Fed is not going to change gears, then perhaps what this ends up looking like is weakness in risk sentiment as the markets start to grapple with what all of this volatility on the fiscal side and a sort of hamstrung situation on the monetary side might mean for broad market outcomes and the forecastability that's needed for risk to be allocated with confidence. Beyond the U.S., this is sort of midweek with ISM and the U.S. jobs report on either side of it, is a monetary policy announcement from the Bank of England. Here we can see we've fully priced in a 25 basis point down step from 4.75 down to 4.5 on the target bank rate. So fully priced in here for another rate cut. And indeed, if we see here the similarities with the U.S., we can see that as the U.S. had a big hawkish revision in policy expectations from September to the beginning of November, and then things have been fairly steady, so too we get the same thing from the U.K. The question, of course, with the rate cut fully baked in becomes, what's market moving here? And because we're going to get a quarterly update of the monetary policy report with this announcement, the answer is quite a lot. There is a flood of guidance this go around with the Bank of England. Not only are we going to get minutes from the meeting, a policy statement, and we are going to get the usual press conference, but this quarterly inflation report, which tends to be the sort of bedrock of Bank of England forecasting, used to be called the inflation report, as a matter of fact. Now it's called the monetary policy report. In any case, it is an update of what the lens looks like for the next 3 months. And the press conference with Governor Bailey, after all of this is published, will be to connect the dots and explain what all of it means. So lots and lots of fodder for speculation here from the Bank of England. And if we look at the way that the UK economy has been performing recently, we get a sort of mixed bag. A little bit of a pickup in economic activity. We can see in January's numbers, 50.4 on the composite PMI ends up being a little bit of a wiggle higher. The situation in manufacturing gets a little bit less bad. The situation in services gets a little bit faster month to month. So a little bit better of a view on the overall economy. And when we look on the inflation side of things, increasingly stasis, but with a little bit of a helpful downtick recently. So core inflation a little bit cooler in the latest readings, down to 3.2%, the bottom of its recent range from last year. And indeed, even the headline, after a bit of an upswing, starting to roll back over unexpectedly, as a matter of fact, down to 2.5%. This, more than anything, is likely to distill attention on the voting on the MPC, the Monetary Policy Committee. And the way the Bank of England does it is one policymaker, one vote. There's 9 of them there, and a simple majority votes on policy. In fact, even Governor Bailey can be outvoted if he's in the minority of that tally. And so looking at what all of this then distills into, that voting tally should be quite telling. If we look now, the expectations are for 8 out of 9 to vote for this cut and for 1 out of 9 to vote for no change. If we end up with perhaps a smaller majority favoring this cut, if this ends up getting the attention of more policymakers and they start to say, well, you know what, if we are going to have this kind of pickup in growth at the same time that everybody is throwing around tariffs amongst our major trading partners, be it the U.S. or Europe, which is threatening retaliatory tariffs on the U.S. Were the Trump administration to move forward with its first steps, then perhaps the move now is not to be cavalier with the potential for inflationary knock-on. And so with that in mind, you could get more on the Bank of England that resist the drive to ease. Now, as it stands, 60 basis points priced in for this year, 13 basis points for next. That's a 2-cut total already in the market for this year, a 40% chance that we're going to get a third move, and then about a 50-50 shot at a cut in 2026. Now, if the tally here is going to be less than convincing, if we're going to have, let's say, only 7 of 9 voting for the cut, or even only 6 of 9, with, let's say, a few peeling off to no change, then we might end up with a situation where, first off, the British pound does well against the US dollar, but secondly, we might get a window into what a central bank might do and how it might adjust to US policy volatility in the way that the Bank of England talks about this. If tariff threats are going to contain dovish instincts at major central banks, that'll be something that can be extrapolated to a great many other central banks also cutting and end up looking like a global yield structure that is stuck higher, which of course would not bode well for risk-taking and for equity markets writ large. And that is Macro Money for today. As ever, we are here right after overtime, Monday through Thursday. That's a show that I co-host with Chris Vecchio and Dylan Radigan, looking at the Wall Street close and what it might mean therefrom. I'm likewise on with Chris for Futures Power Hour, Mondays and Fridays. On with Victor Jones for The Price of Truth on Tuesdays. Back with Victor and Tom for First Call on Sundays. Writing for the News and Insights portion of tastylive.com and commenting at Ilya Spivak on the platform formerly known as Twitter and on Blue Sky. Thanks very much for joining. If you're watching on YouTube, like and subscribe. Macro Money is back tomorrow. Happy trading.